Now, what also did we learn in 08, 09? We learned that a lot of business models that were very respected, a lot of stocks that were loved back then, right, were suddenly hated, as in cyclical business models. If you look prior to the great financial crisis hitting, people loved cyclical businesses. They loved the home builders. They loved the banks, the financial institutions, right? Then 08, 09 hits, and suddenly everybody's like, I don't want to own cyclical companies. Those are bad. Don't give me a home builder. Don't give me a bank. They suck. Don't give me an auto company. They all suck. And what have we seen ever since 08, 09? Even as those companies' profits, exploded to the sky, does anybody pay any sort of big valuation for a bank nowadays? Or a home builder? Or an automaker? No, unless you're Tesla, okay? That's the one exemption. But outside of that, no one was willing to pay anything for any of those type of companies because cyclical businesses were seen as bad, right? And what we learned from that is you got to stay away from cyclical businesses unless they've already crashed. If they've gone through a 60, 70, 80% crash, then you can pick it up as a 1-2 year kind of, we can call it medium-term trade or a medium-term investment, we'll call it, being in it for 1 or 2 years. But at the end of the day, whenever times look great, you don't want to buy the home builders. Whenever times look great, you don't want to buy the auto companies. Whenever times look great, you don't want to buy the banks. The only time you can consider buying those sort of companies is when they've already crashed 60, 70, 80%. Other than that, they're a don't touch. And that's what we learned from 08, 09, right? And a lot of the biggest companies in the world, the smartest business models, they realized after 08, we've got to change our business models to more recurring revenue streams. Because when you go through a major recession like that, people dry up spending, right? And they're not like, I'm not going to go buy a house right now. I'm sorry. I'm not going to go buy this. Not going to go buy that, right? And so a lot of companies prior to that were very focused on selling a product, right? And now if you look at all the biggest, most powerful companies, they're all like recurring revenue stream. Even Apple, right? You really break down Apple's business model and it's like, yeah, they make so much business from selling a new iPhone and computer, but a lot of that is just replacement revenue nowadays, where essentially somebody's iPhone breaks and they just got to go buy another iPhone, right? Somebody's MacBook breaks and they just got to go buy another MacBook because their old MacBook they've been using for 6 years finally crapped the bed, right? And so they're like, okay, I'm going to get a new MacBook. But you really look at the services revenue, which is the golden goose for Apple nowadays, right? That services revenue, that was something that didn't exist prior to 08, right? And then Steve Jobs built the business model and really focused it around like the services opportunity, right? And it's been a game changer for that business model ever since. Microsoft, same exact thing. Like people forget about the days used to pay like a one-off fee for Microsoft's products, right? Not anymore. Now you look at all their products are basically recurring revenue streams that you have to pay for monthly or annually, right? NVIDIA's even trying to go that route of a recurring business model. Like NVIDIA, right, is trying to even go that route now at this point in time, right? Because they realize their business is so dependent upon how many chips they're selling at a particular time and the price points. And so they're even trying to focus their business more and more on software, right? And so it's fascinating to even see a company like that say, geez, we would love to be these other companies, right? Google, you look at a lot of their components of their business, a lot of recurring revenue streams in their business, right? Amazon, even a company like Amazon, right? Think about how much Amazon has changed since 2008. Amazon Prime now is a huge thing. That wasn't a thing before 2008, right? AWS, no one cared about AWS before 2008. That's like a huge component of their business that companies have to stay signed up for AWS. You don't just quit AWS. That's not the way it works, right? And you also think about how much Amazon over this last 10, 15 years has pushed into needs-based products. They want you to order your soap from Amazon. They want you to order your deodorant from there and your toothpaste, right? And all these needs-based products, where if you think about Amazon prior to the great financial crisis, if anybody even used Amazon back then, it was more for like one-off, like I'm going to go buy a CD on there or a DVD or some sort of new electronic or something like that. It was a lot of one-off purchases. And now Amazon's built their business model to be like a grocery store almost, like stable business model, right? And so it's fascinating to kind of see how all this plays out. Now, this takes me to kind of how I'm thinking about investing for the remainder of 2025, right? Because first off, you got to understand, anytime the NASDAQ falls 20+%, it's a phenomenal time to be buying growth stocks specifically. Because usually what happens when you have a NASDAQ go down 20+% in a pretty quick amount of time, right, is growth stocks get hit hardest. And, it's just always the way it is because they trade a bigger valuation. So when people get more uncertain, they come back to what? Valuation. And if they don't feel comfortable with the valuation, they say, I don't want to own it. No, thank you. And so I'll be focusing a lot of my attention definitely on growth stocks, right? Now, I'm going to finish up my buying in April on the beaten down dogs. The beaten down dogs are Nike, Elf, Estee Lauder, AMD, a lot of those companies, right? Now, the special thing with these companies is these companies were already getting hit prior to the big correction, right? Now, the correction comes and just takes it to another level. And so you get certain time periods when, and I could even take you back to the 2022 crash. I could take you back to the 2020 crash. There's certain time periods where you get certain stocks that were already attractively valued, but then they go into, a crash in the market or a major correction, and they just trade down to ridiculous levels because those stocks were already heavily damaged before. And so by the time you get to a crash, it's just impossible to find buyers. And the selling pressure is just relentless. And so that's why a lot of those stocks I just ran you through there, right? The Nikes and the Elfs and the AMDs and those stocks, they're trading at values you just couldn't even have conceived of a year ago, right? Or even 2 years ago. It's just like, especially a year ago, like who could have thought AMD would be trading at, last week AMD was trading what, $80-something a share? Last week, Nike was trading, just ridiculous levels in EL and Elf and a lot of those stocks, right? And all based upon the fears of tariffs and this and that. It's all going on, right? So I got to finish up my buys in regards to those over the next, I got another 2 or 3 weeks to continue to add to those. And then I'm about done as far as buying those because I'll be good with kind of what I own at that particular time. It doesn't mean they're not still a buy. Those stocks are a buy all the way through the end of the year. It's just for me, somebody that's been buying those stocks very heavily, I'll likely conclude my buying here very, very shortly, right? Now, also on my X, I posted my base case, bull case, my updated base case and bull case for stock prices in regards to these three, okay? And by the way, if you don't follow me on X, I always have it linked in the description area of my videos if you ever want to follow me on X, okay? But here's my base case for Nike and bull case for Nike. I have a base case of 125 and a bull case of 175 based upon where I see their net income going over the next few years and based upon where I think they're going to be properly valued as far as P ratio. AMD, and then base case 200, bull case 300. I took down my numbers a little bit in regards to AMD just because I think there's going to be more uncertainty out there over this next bit of time, and that might hurt numbers at least a little bit as far as later this year or 2026. AMD is still going to be posting great growth regardless of all the uncertainty and what Trump going to do and what's going to be the growth outlook and all those things. AMD is still going to report great numbers. I'm just taking it down a little bit. So still very attractive ROI there, right? Even today, even after the bounce recently, it's still $90-something a share. Elf, my base case is 150 on Elf. Bull case is 250 on Elf over the next 3 years. I think that one's going to bounce hard. Hard. This whole tariff stuff is so overblown in regards to Elf. Oh, by the way, and if you wanted some other good news in regards to Elf, I actually posted this in the Elf chat. Kramer got asked about Elf on Mad Money. I had CNBC on in the background while I was prepping this video. And I'm like, oh, they're asking Kramer about Elf. This should be interesting. And he was basically like, I can't recommend buying that stock at 53. They got all this China exposure and all the same crap. And I'm like, oh my gosh, they don't even realize like Elf sells these very affordable products that if Elf goes up 50 cents or $1 on it and completely offsets the tariffs, people aren't going to revolt and stop buying Elf products. It's not the way it works. And so that was just fascinating to see, Kramer basically, preach against Elf. Might be a good sign, huh? Might be a good sign there. Now, as far as May and through the end of the year, right? Now, this is assuming no major market crash. Like, let's say, some massive next black swan event comes out of nowhere, right? And S&P, NASDAQ goes down to the 10-20%. That could change up some of my opinions, but assuming we have no major market crash for the remainder of this year, here's how I'm looking. I love this stock. Adobe. I haven't started buying it yet, but don't be surprised if I enter the position very soon here. ADBE. Adobe is just so well positioned, in my opinion, right? Here's the deal. We were talking about, international as a risk. Adobe gets 70+% of their revenues from the Americas region. So they're not super reliant on international markets to try to meet numbers or something like that, right? Additionally, it's a growth stock trading at a great valuation right now. It's valued like a value stock. Additionally, we spoke about it, recurring revenue streams. Adobe's got one of the best recurring revenue streams you'll ever find of any company out there. It's tremendous recurring revenue stream for Adobe. And so when I look at Adobe, I'm like, oh my gosh, would I love to just start a position in this one in the month of May and just build it over the remainder of this year, because that's one I'll feel very comfortable in over the next several years, holding that one, right? So that's definitely a stock I'm strongly looking at. Now, in regards to Adobe, it's going through an annoying time in regards to stock price, right? Because everybody's like, all the analysts, when the stock does bad, they start bringing down their price targets, right? And so Adobe's had to go through that over the last week or two. So D.A. Davidson here, they just cut their price target to 450 from 600, right? This one's just today also. This one was by RBC Capital. RBC Capital just took their price target down to 480 from 530. This one was on the 11th of April. They took their price target from 410 to 380. This one, Evercore ISI, this one was last week? They adjusted their price target from 550 to 475. So Adobe's going through that phase right now. And at the end of the day, as a long-term investor, I don't care anything about that. And usually when all these firms are, bringing down price target, usually you're at the bottom, because that's usually the last signs of a stock. At least if it's a good or great company that's going to start to turn things around as far as the stock price goes. Usually you're at the bottom when it's that phase when all the analysts are bringing down their price targets, because that's usually the final phase. Like, I've seen it just continuously over the years. So that's an opportunity to see. Honest, HNST, I think is a great opportunity as well. A lot of Honest's products are made in where? America. So the tariff situation doesn't hit Honest nearly as hard as it hits a lot of companies. Like, some products, some things they get outside the America, but honestly a lot is United States based. And so needs-based business model as well, right? It's not like, at the end of the day, if you got to buy diapers, you got to buy diapers. If you got to buy cosmetics products, right? And soaps and lotions and things like that, you're going to continue to spend on that. And so needs-based, impressive balance sheet at the company, incredible balance sheet actually, impressive cash flow at the company as well. And so I think a company like Honest is a really attractive stock now at this point in time, right? Even a stock like Fubo. Like Fubo, think about it. Like, where are they getting all their money from? USA. Do they have to deal with the tariffs? Do they have to deal with, we're making a product in China and then it's going to get shipped here and we got 100 billion% tariffs to deal with? No, they don't have to deal with any of that, right? Recurring revenue streams, they're close to profits in regards to that company, right? The Disney deal is likely to go through in the next 90 days. And so I like the backdrop for even a stock like Fubo quite significantly. And this one might come as a surprise, Whirlpool. I like Whirlpool. I wouldn't mind starting a position in Whirlpool. And the reason being is, remember what I told you guys about the cyclical stocks. There's only one time to really buy cyclical stocks, and that's when they've already crashed 60 to 80%. When you can get those stocks after they've gone through a 60, 80% crash, it's usually a great buying opportunity, right? And I'll take a risk on basically any good quality cyclical company if the stock price crashes 60, 80%, right? Toll Brothers, another perfect example. Like if Toll Brothers stock crashed 70, 80% from the recent highs, I'll gladly buy Toll Brothers stock and hold it, right? Same thing for a lot of companies, even a Tesla or companies like that, right? Whirlpool. Stock's down 60, 80% from the highs. I think it's down, 67% or something from the highs back in 2021. And so there's two ways I could go with the Whirlpool. I could buy shares straight up, or what I could do with Whirlpool is, let's say I was thinking like, I'm going to put $100,000 in Whirlpool. Instead of putting $100,000 in Whirlpool, I could always just do like $10,000 in out of the money call options that expire in 1 to 2 years on Whirlpool. Now that's a risk, because let's say, my belief is in the back half of this year, we're going to start to see a turn in terms of the amount of transactions happening in the real estate market. I believe mortgage rates will come down. I believe people will get moving again. And I believe that will just be the start. And then we'll see a big acceleration in 2026 and 2027. The real estate market's been frozen for, 2.5 years now at this point in time. I believe it starts to thaw out in the second half of this year. And then 2026 and 2027 gets back to a normal. And that's going to be phenomenal news for a company like Whirlpool. And so I wouldn't be surprised at all if Whirlpool stock goes to 150 or 200. Let's call it 2 years from now, 2.5 years from now. And so some out of the money call options, that's another opportunity there. So I don't know. I'll think about that one some more. But definitely Adobe kind of takes the cake in terms of just like a perfect situation with a perfect stock. Learning what we've learned from 08, 09, what we learned from this recent situation, right, with the tariffs and everything. And Adobe just seems like one of the most well-positioned companies I can possibly find with financial statements that are absolutely phenomenal.
How would you like access to all my best course curriculums? My Becoming Master of the Stock Market course, my Stock Market Investing Mastery course, my Stock Options Mastery course, my Millionaire Playbook. How would you like access to all my best courses, as well as the ability to have access to my 6 and 7 figure plus Discord community, where we're constantly keeping in touch with each other, talking about what's going on in the market? How would you like exclusive weekly videos from me? How would you like the ability to see what stocks I'm buying and selling in my $2 million plus Fidelity account? If that all sounds pretty interesting to you, apply to join my private group. That is going to be linked in the description area down there. You can click on that, fill out an application, and go ahead, hop on a call with Andre. Andre will walk you through the whole process. He'll walk you through the whole group, and you can go ahead and join us in there. Once again, the link for that is in the description area.
Let's get into this. This is the message I sent to my private stock group members last night. I said, someone said something that I thought would be worth addressing from today's video, and that was yesterday's video on the main channel that I put out, right? I said, they said something like, Jeremy, I thought you would be more happy, excited recording today's video, given that it was the second best day in NASDAQ history. And I guess because I was pretty stoic in that video, people were like, why aren't you like happy, like super excited? You know, it was the biggest day in the history of the public account yesterday. The public account was up, gosh, I don't remember, $335,000, some crazy number, like just ridiculous, right? Never mind, plus all my other portfolios. And I said, my thoughts are, why would I be all super happy and excited yesterday? Why would I be? One, if I get all emotional about upward moves, then I'll likely get emotional about downward moves. Emotions and money are like oil and water. They don't mix. As somebody that's been in this game now 16 plus years, and somebody that's gone through several crashes and countless corrections, right? Remember, I got started in one of the worst crashes in history, the great financial crisis, right? From there, we had a lot of major corrections over the coming years, a lot of big corrections, including 2018, that was nearly a stock market crash at the end of the year. Then we had the 2020 crash. We had a crash in 2022 where the NASDAQ fell 37%, peak to trough from where it peaked at in 2021 to where it troughed at in 2022. And now we're going through this thing. I can just tell you, you don't want to get emotional. You don't want to get emotional when you're having those upward days because, man, you're going to get emotional on those downward days. And the worst thing you can do in the stock market is get emotional about all this stuff. And I understand for a lot of newbie investors, like you're in your first year or two or your first few years, a lot of those individuals get very emotional about the market. It's just going to cost you money. I don't know any other way to put it. It's going to cost you a lot of money. The more emotional you are about this game, the more money it's going to cost you. You just got to be stoic in this game. And that comes with experience also. As you get more experience in the market, right? Like for me, there's really nothing that could happen. Like the S&P 500 could go down 27% tomorrow. Means nothing to me. Like I'm just at that place that it is what it is. You know, you've been playing the game so long and you're so experienced at it, there's nothing that phases you. The S&P 500 go up 27%. Like just a ridiculous move that's never happened before. And at the end of the day, once you get experience in it, like you know how to handle it. You're like, okay, this is what we got. This is what we're dealing with. Okay, we'll go ahead and adjust. It's like being a professional athlete. Like if Michael Jordan went down 27 points in a basketball game, do you think he was panicking? No. It's like, okay, this is what we got to work with. We got a 27-point deficit here. Like, we're going to figure out our way to climb back from this, right? That just comes with experience. And so just understand for all you newbie investors, in your first few years, man, like this is just part of the process. Like you just got to be stoic in this game and, roll with the market. The market's a roller coaster. There's a lot more fun times than bad times, but it's a roller coaster ride, right? 2, all stocks I love buying right now just got way more expensive. I like to buy my stocks for as cheap as possible. That is such an important point I make right there. Listen. For me, I'm constantly buying in the market, right? I'm buying every single week. And as everybody watching this video right now, you should be buying stocks at least every 2 weeks or at least once a month, okay? But you need to be buying stocks as actively as possible. If you work a job, you got more income than expenses, which is what every single person watching this video right now should have more income than expenses. You need to be buying stocks as actively as possible all the time. So given that I'm consistently buying stocks all the time, I want to buy my stocks for as cheap as possible. I mean, at the end of the day, if I love AMD, why would I not want to buy AMD for $1 instead of $87? Like, I could get a lot more shares at $1. I would love to buy Amazon at $1 instead of $180. It's a very simple game. I want to buy my stocks that I love for the long term for as cheap as price as possible. Why? Because I get to buy a lot more shares, one. Two, I'm going to make a lot more money long term. A lot more money. That's very important. Three, said many of the largest upside moves in the stock market history occurred during bear markets. Gains come and go. Oh, is that very evident today? Okay, and I'm going to show you in just a moment. We're going to go through some of the biggest gains in stock market history and where the market ended up going over the next few weeks or next few months. Okay, as I hope all that makes sense on why I wasn't popping bottles of champagne today. Have a great day, right? That's why you didn't see me out there celebrating, going crazy. Oh my gosh, we made so much money. At the end of the day, this is just part of the process. This is just part of the process, man. You know, I celebrate over 5 and 10 year spans. Other people celebrate or get freaked out over 5 and 10 day spans or 5 and 10 week spans. Like, it's nothing. Next up here, I posted this on my X. By the way, if you want to follow me on X, I always have it linked in the description area of all my videos. So if you're active on X, formerly known as Twitter, you can certainly follow me on there. I've been posting a lot on there recently. So rule of thumb, always load up on stocks when the put to call ratio is 1 or above and the VIX is 50 plus. Doesn't mean you'll get the absolute bottom of the market, but you're getting close. Has never failed in 40 plus years, right? Decades and decades and decades you can go back. Never fails. And so if you're thinking like, okay, put to call ratio is over 1, VIX is 50 plus or 30 plus, 40 plus, whatever, right? I'm going to get the absolute bottom of the market. It doesn't work like that. It doesn't mean like today I'm going to get the bottom, but you're getting pretty dang close every single time. And I can take you back through every single time period for, over the past many, many decades. Go back to even before I was born, never mind before I was in the stock market. Every time you see that put to call ratio go crazy and the VIX spike insane like that, it's a huge buying opportunity. Huge buying opportunity. That's what we're witnessing right now. Doesn't mean you're going to get the absolute bottom on the market, and you don't have to. Like, you got to understand, when you're buying in a crash, you're getting such attractive pricing on stocks, you don't have to worry about getting the absolute bottom. It's irrelevant. Listen to me. It's irrelevant if you get the bottom when you're in a crash. All that matters is you're buying, because you're likely getting stocks at year or multi-year discounts. 3-year discount, 5-year discount, 7-year discount, 10-year discounts. And that only happens like, once every 10 years or so. And so you don't have to get the bottom. You're going to make so much money over the next few years as long as you're just buying along the whole crash. And then as you come out of that crash, you keep buying. You keep the pedal to the metal. That's all that matters. Whether you get, if you're trying to buy Amazon, whether you buy Amazon at 160 or 170 or 180 or 190 or 200 or 155, it doesn't matter in the end. All that matters is you were buying Amazon during this crash. Same thing with the 2022 crash. Same thing with the 2020 crash. Same thing with the 2018 crash. Same thing with all the corrections we had over the years. Same thing with 2008, 2009. You didn't have to buy right at the bottom. I got it right at the bottom. I bought March 2009. No. All that matters is you were buying that whole crash and you bought the way up. You made so much money. It was ridiculous. So much money. Incredible amounts. Like, you were such a happy camper 5-10 years from then, right? Like, oh my gosh, you were buying the whole great financial crisis crash, right? You were buying that whole thing. Do you know how happy you would have been by the time you got to 2018, 2020, nowadays 2025? Even with this crash, look at where stock prices were then versus now. Okay, so that's very, very important here.